Morning, everybody.
Good morning.
What's up, Lil Kim?
Good morning.
Morning.
Yeah, let me send a message so that they'll know you. It's on and popping.
Wait a minute, you said so they'll know what?
So they know it's meeting time, god dog.
Oh,
Yeah, I know you're teaching today.
no. That's why I was like, say what? What'd you say?
And everyone. All right, y'all ready?
Yeah.
You know, this glare. I can't trade that call. So we got 12 folks. 12 people. Got it, 12? 12. 13, 14. Drinks and cooks must be flowing and built in rules. It must be. Okay, so it's guess we're close enough to 20. I know last week we kind of got on a discussion in reference to I guess finance 101 or economics 101. So I kind of wanted to continue down that line and kind of discuss in more detail the current environment, as far as what we're looking at. Because I don't know that all of you guys know, but we have a storm brewing, and I don't know if we can call it the perfect storm, but there's a lot of people out there that understand economics and finance better than me that feel like it's the perfect storm. So all of us who trade, I think are old enough to understand at least what happened in 2008 and 2009, up into our current environment. So we all know that we had a financial crisis in 2008 that ended with a housing bubble, right? And prior to that housing bubble, you had everybody who could speak and who had an official title saying that we would have a soft landing or we weren't in financial peril or anything. Then all of a sudden you got the biggest financial meltdown in history. And we're in a similar spot today, pretty much, where everybody who can speak is saying that we're in good shape, right? The Fed is still hoping, you know, for a soft landing. But what does that mean for you as an individual, or your financial situation as an individual? And, you know, basically, are you prepared to go through what we might have to go through, you know, in a bad financial situation? So there is a YouTube video out there, but it's like 3 hours, right? And I don't want to play a 3-hour video because we're not going to be able to watch it. But I can summarize for you what basically the consensus is in that video, all right? But we'll talk about the issues first. Is anybody in Mississippi, by the way? I know it was a tornado that hit Mississippi last night.
You are, you know, it's terrible. Not because of the tornado, but just because of your surrounding environment.
I would try to find that the title of that video, and I drop it in the chat.
Okay, cool.
Okay, so basically, we're facing 3 issues in our current financial situation. High interest rates is the first problem, and you know, I think it's obvious why we should recognize it as a problem, because if the interest rates go up, of course, we pay more to borrow money, and even if you're not a money borrower, you might be a chronic credit card user. And it's essentially the same thing. And the thing that most people don't realize or understand fast enough is your credit card is the first rates that are going to go up, you know, and they're going to go up a lot. So if you're somebody who just shops with credit cards and you're like most people who don't watch their money, you might wonder why, you know, your payment is so high, or it's taking you so long to pay something, and it's because you're paying a lot in interest. So that's an obvious problem. The initial problem that we're facing is this high inflation, right? And inflation is caused, you know, for several reasons, but the main reason that this inflation is around is because we're printing money. We're adding money to the inventory. And anytime you add more of something, it cheapens the value of it, you know, same with cars, same with clothes, golf clubs, whatever. The more you have, the cheaper that item becomes. So never before in history have we closed the economy down. We stopped generating goods and services, but we still pay people. So nobody has a ironclad number of the amount of dollars that we printed, but it is well over the $6 trillion mark. $6 trillion. There's a number out there, like if you Google how much money has been printed, a number will come back that said 40% of all dollars ever printed were printed in the last 4 years. So
Who's our president?
that should tell you a story. That'll paint a picture of how much damage or how much we've cheapened the dollar. And, it is what it is. The pandemic was here. We had to do what we had to do. But, there's still a price to pay for doing that. So there's a price to pay for us printing that money and taking care of everybody. So that inflation is high, right? Over the last 2 years, the inflation is about 15%, right? So inflation rose 15% and wages rose 13%. So you're still at a 2% deficit if you're working. But if you think about things, we can't be in an environment where we're paying or it costs 15% more to live every year. So that's why the Fed came in and started jacking up the interest rates, right? So if the Fed had not did anything, we might be higher than 15%. Well, we would be higher than a 15% raise because we turned the economy back on. Everybody had plenty of money, whether you had a job or not, because the stimulus was still coming in. So now that you're able to go outside and spend money, or you're able to go travel, people would have just picked right up and jumped back into their regular lives and started spending money, and probably would have went a little bit overboard because you had a little bit extra. What America has done a great job of is dumbing down the people. Like they don't educate us as far as financial literacy. They don't educate us on many things. In the video yesterday, the guys were like, in high school, I learned calculus, but I didn't learn how to balance a checkbook. And when you think about it, it's really a sad state of affairs, but the powers that be make these rules. We, the voters, don't ever challenge the rules, and we end up in a situation that we're in now. So anytime that there's turmoil or danger or peril, we're none the wiser. It's kind of like the rabbit that's outside playing and the snake is sitting there. The rabbit doesn't understand the apparent dangers, and we don't either. So here we are, we find ourselves in an environment where we have runaway inflation, and the Fed's jacking the interest rates up to slow down that inflation. And the banks are collapsing because they were over leveraged. The same way your account over leverages, and when the trade goes against you, it collapses. That's what happened with the banks. And, in the midst of all this, we have a slowing economy. And when I say those three things, for most of us, it still doesn't click. It doesn't register how big of a deal this is. But let's talk about how things work. So the government is it's not a business. Like, it doesn't generate revenue. The way the government gets its revenue is from me and you. We make money, businesses make money, the government taxes us and it taxes those businesses, and it gets a paycheck. So that's the only way that the government can generate money. So if the government needs to pay debt, right, which is also attached to the dollar, if the government needs to pay debt, the only way it can pay debt is by taxing me and you and the companies getting that money and paying the debt. Okay, so let's talk about the tax base for the government. The tax base is directly connected to who's employed, what companies are doing well. Like if you look at the stock prices, and the economic health of the country. If the economic health declines, the government paycheck declines. So if you understand the environment that we're in, where the government, we owe money to other countries who've lent us money. We owe money to, as far as trade and trade deficit. And when the interest rate goes up, the government, much like us, we owe more money. So if you look at what's going on in Congress today, we have, you guys hear about the debt ceiling, right? And how it's just a number, we can raise the debt ceiling and all that good stuff. But right now, we have so much infighting in our government that they're not focused on the right thing. They're infighting about the debt ceiling, right? Which should increase the level of debt we can carry. It's kind of like increasing the number on your credit card, So all we have to do is add another zero and we'll be good to go. And that's a short-term fix. But if you extrapolate this problem out, we're in a bad situation because, just like the government, just like us as individuals, we are consumers, and we're beat into this mindset of spending. It's no different than if you couldn't pay your credit card bill and you just went and got your limit extended, but you kept spending at the same rate or even at a greater rate now that you have more of a limit. It's not solving the issue. The issue is you've created bills that have outpaced your earnings. So either you're going to have to find a second job or you're going to have to stop spending freaking money, right? So the US government can't really stop spending money, right? So we can't find a second job, and right now the Fed is trying to destroy the job market that's out there. And it's trying to destroy that job market because the interest, the inflation is too high. So we find ourselves in the middle of these three tornadoes, trying not to get hit. We try not to get whipped by the inflation. We try not to get fired by the slowing economy. And we try not to go out here and create more debt with these high ass interest rates. All right. So this is the problem. You don't need to ask somebody, are we going to be okay? You have to be able to take the temperature in your own room, right? You have to understand, okay, I owe this much on my house. You're in a fixed mortgage, you're fine. But if you're in an ARM, you at this point, you might be out of your house. But if you have something that's on a flexible schedule, like a credit card, you don't need to use that right now. You have to find other ways to finance your life, which means you need to spend less. You need to pay off those credit cards. You don't need to use those credit cards in these perilous times because, today you wake up and it's 22%, tomorrow you wake up it's 40. So, the higher the Fed jacks the interest rates up, the higher the prices on things go, right? To where, you might go and buy a house over the next 2 years, maybe your interest rate is in the teens, maybe it's double digits. It was like that, when I was a kid. So it's not that it's undoable, but I think that this generation of people have to take the blinders off, right? We've lived in this environment where everything was free or close to it, and now we have to pay the piper. And the further we kick the can down the road, the more we involve our kids and their kids in this environment, and that's what happened pretty much to you guys, because we had this problem has been brewing for years, and it's been exacerbated by a few things. But if you go back to the Iraq war with Bush #2, he didn't budget for that war. He just, it kind of happened. So we never finished paying for that war. And we've been in 2 or 3 other conflicts since then. We're paying for the conflict over there in Ukraine right now. We're paying for the COVID. All of these things are happening, and the Fed is trying to beat down the tax base. So eventually, once the inflation gets down and under control, we'll go back to an environment where we create, we have big businesses, but then we'll run into a new problem. The new problem is the rich people will still be trying to hide the money. Nobody want to pay the piper. So nobody really knows how this is going to end, but there are a few things that we need to look at, right? Gold is, close to a record high, 2000 and change, right? And why? Who's buying all the gold? And why is it at such a record high? Why is the dollar going up and gold is going up at the same time? If you look at what's going on with the Chinese, they are, in the bed with Iraq. They just got Saudi on board, with this new treaty. They have a couple of countries in Central America that don't recognize Taiwan now. So, China's working hard to become, the superpower. And at this rate, I mean, who knows, it might happen. But the reason why all these countries are buying gold is because there's, people are trying to work to take the dollar out of the top spot, right? Because you mofos is printing money at an alarming rate. And, I mean, we can do that because we have the reserve currency. But, other people aren't in agreement with us just, having the presses rolling, and we say presses rolling, but nowadays it's probably digital, right? You don't even have to print it. You can just add zeros to it. So just so you're aware of your surroundings, like the economy is no longer, the American economy. It's a global thing. It works. Everybody's economy is intertwined. So you have to understand how to at least balance your personal books and how these numbers and interest rates and inflation affect your wallet. So you don't have to wait for somebody to get on the news and tell you, hey, man, this is going to be a hard landing. No, it's going to be a hard landing. You already know it because you got all this money sitting on your credit card instead of paying your credit card off. Now is not the time to be buying, to be adding debt. It's just not. Now is the time to be, cash positive or whatever. And if you don't know, just always look at what Warren Buffett and them are doing. These dudes, they got a lot of cash. They're not heavily invested in stuff, as far as stocks. I think that we have a long way to go on the downside before we start turning around going up. There's been a lot of interim runs and all that stuff, but the real problem has not came to a head yet. Inflation is not under control. Interest rates aren't at the rates that they need to be to start bringing this thing down. Like the banks are already crumbling. And, we talked a little bit about the bonds, bonds are nothing more than the government loaning people money, or, the government borrowing money from people and saying, hey, I'll give you this money back in 2 years, right? I'll give you this money back in 4 years. And I'll give you this interest rate. And, my brother touched on the short-term yields being higher than the long-term yields and all that, but it's because the government has to keep borrowing money on the short term and the interest rates are high. So if interest rates are high, then they're going to have to make it more attractive for you to give up your cash, right? For you to loan them money. So they need to have your return high as well. So that creates that imbalance. And it's just not going to get any prettier in the short term. In the short term, it might get a little bit uglier, right? The government is targeting, I guess, a 4% unemployment rate. If they're telling you this, you should believe the people when they're telling you that. So until you see the unemployment rate hit 4%, then you don't even need to ask if we still raising interest rates. Just assume that what they're telling you is on the up and up, right? Because these numbers are real numbers. Now, the pain that we're gonna see getting to these numbers, you know, like these banks crashing, that's some of the pain associated with us having to get to these numbers. And that's what old Fed Powell was speaking of, you know, over the last year when he said it's going to be some pain. So when you see mass layoffs and stuff like that, that's just going to be part of the pain process. You just want to make sure that you aren't in a situation to where you might have added a debt. It's not, you know, don't go get your F-150 this year. Don't go get your Lexus coupe or whatever, you know, like, because that stuff, you know, the uncertainty is going to be massive. You know, I don't know what industry you're in. I don't know how it will be affected. But I would remain on the sidelines as far as adding debt until you see that light, whether it's a freight train coming at you or not. You know, we need to see some light at the end of the tunnel, because we don't know how deep this is going to get. We don't know how horrible it's going to get. And we always try to avoid depressions. Maybe this is the time that they don't avoid a depression, and we go from a recession to a depression. Now, I don't think that the that the American government will let will let us go into a depression. We will crank up the printing presses before that happens, but that's not solving the long-term issue, right? I do believe that we'll have a stimulus and we'll drop interest rates, but I just don't believe that it's going to be as soon as you hear a lot of these pundits saying. You know, like I keep seeing stuff like interest rates will start dropping, you know, the second quarter of next year. And I'm just like, man, you know, I don't think so. You know, I mean, maybe it will, but I'm not buying it. The numbers don't bear that out. You know, the numbers say we need to raise the interest rates more. You know, every time you get a CPI report, or not a CPI report, it was a little bit down, but the job numbers, it's a strong job report. You know, the consumers feel great. They're still spending freaking money. You know, you have to start hammering that interest rate. You know, like we still have to raise interest rates. So until the numbers bear it out, then I don't believe that we're out of the woods yet. And hopefully you won't either, because it's easier on us if we don't spend as much money and we have money, and the only thing we did was miss out on getting a car a year earlier. Because when they drop the interest rates, you know, it's going to be a better deal for you to go buy a car anyway. But it's going to be real crappy if you go and buy new stuff, or you go out and run up new credit, and then you go into default because the hard times haven't hit us yet. So I would just encourage you guys to be vigilant. Like, do your own homework, do your own research, understand how the three-headed monster affects your personal finances, right? Can you cover all your bills right now? Do you have a surplus? What are you doing with that surplus? You know, you have a lot of people saying buy the dip. You know, my question is, you know, are we finished dipping? And I guess if you dollar cost average, it doesn't really matter, because, you know, if you bought now and then it dips and you buy more, that's cool. What I'm telling you, don't go all in thinking that this is the low point. You know, don't spend all your cash, you know, thinking that we've reached, you know, the bad part, because that's not necessarily the case. You know, you have to wait for the numbers to say that we've reached the bottom. And don't listen to any pundit, anybody getting paid to do a job or getting paid to say something. Don't listen to those guys. Look at the number. What is the number telling you? What is the data telling you? Where is inflation? We already know what the target is. The target is 2%. Where is inflation? And if we're not close to that 2% number, don't believe the hype. Don't believe the hype. where are your interest rates? Right? Like, are they low or are they high? They're high for you because you've never seen them this high. So do you want to pay 9% for a new car? Do you want to pay 11% for a new car? Do you want to go buy that dinner that's going to cost you 26% when you put it on your credit card? Those are the types of decisions that you need to make. And if you don't know what 26% is, I mean, have you made 26% in your trading account? You know, it's a lot of money. And the problem with us is we're dumb, like they dumbed you down. So it's all it is a number like 26%, but you don't even know what that means as far as dollar wise, right? So I encourage everybody to start doing the math. Do the math in your head, right? Like write the numbers down, put it in your phone. Everybody's iPhone or whatever phone you have, everybody's smartphone has a calculator on it. Do that math. If you can't pay your credit card balance in full at the end of every month, you're doing something wrong in this environment, in my opinion, right? Because you're going to end up costing yourself way more money, you know, through this duration of these hard times. You're going to spend way more money than I am. And, you know I'm cheap and all that other stuff, but the bottom line is I'm not going to be affected by interest rates because I'm not using credit cards, right? I'm not going to be affected by a slowing economy because I don't have any credit. So what you need to do is get yourself to a situation to where even if things hit the fan, you are covered. Your family is covered, right? You're not depending on somebody else to rescue you from a bad situation. And I got it. You know, maybe you're not at a spot to where you can do that right now. But I'm saying that's where we need to be working to get, right? We need to get to a point to where we're not on the government time or the government's check, because at the end of the day, if they fail, you're going to fail if you depend on them. So if we need, if we can get ourselves to a situation to where we have a little independence, then maybe it can soften our personal landing. You guys have any questions? I know we had 1,000 questions last week about all this stuff. Let me see if I can find this video. I'm going to have to find it and just drop it in the Discord. All right, I'm gonna play a video from Rich Dad Poor Dad guy. But I'm gonna drop the video that I'm talking about, the 3-hour video. I'll drop it in the chat.
Oh, took your advice. I bought a house. I made some money. I said, at the top of the frickin' market. Don't listen to your stupid real estate agent who tells you that, oh, the price of real estate always goes up, because it doesn't. When I hear people coming up to me, oh, the price of real estate going up and they're jumping in to buy real estate right now, I don't say anything. And the reason is that people are just getting into the hype. All this credit, it's actually debt, credit and debt, pumping into this economy, trying to prevent this crash. And if inflation keeps going, I get richer. I am extremely happy. And I think Biden, I'm not Republican or Democrat, he intentionally wants inflation. That's why he shut down the XL pipeline. That's why he stopped drilling, to get oil prices up. When oil prices go up, you have all these truckers in Ottawa screaming they can't get food to the table and all this. Prices of food go up. Inflation keeps going up regardless of what's going on, just because the policies of the Biden administration, shutting down the XL pipeline, stopping drilling of oil, so the price of oil goes up. I watch all this. And meanwhile, these people are jumping out and buying real estate like there's no tomorrow, and I can't even talk to them. We're on a turning point. But please understand, ladies and gentlemen, inflation makes the rich extremely rich. The middle class will pay higher taxes, and the poor will get poor because they're the ones who can't afford the $25 Wagyu steak that my friends are selling. So that's why we're one of the biggest critical turning points. And that's why I don't know how many years ago when I walked past Rich's book and Borders, and it says a dollar crisis. If you understand what's going on, the problem is the US dollar. Because in 1944, it stopped being money. It just became the reserve currency of the world. And then 71, Nixon took the dollar off the gold standard. We're being set up right now, one of the biggest changes in world history. And it's, oh, I bought a property. What do you think? I can't even talk to them, because this to me is 2007 all over again. And then the repo market collapsed. 2008, the market collapsed. And back in 2008, this guy named Bernanke, I believe it was, could print money. And this is where we are today. You've got to wake up, ladies and gentlemen, because otherwise you're just this stupid little hog just driving to slaughter. So America is one of the, we're at, not just America, we're one of the biggest turning points in world history. And like there was Rockefeller, one of those guys said is, when shoe shine boys are giving you stock tips, time to get out. And I was in Safeway the other night, and these people are coming up to me, I did what you said, I did what you said. I bought a rental property, I bought a rental property. And I came back home and I said to Kim, time to sell. It is so dangerous, but you can't talk somebody out of it because they drank the Kool-Aid. So that's why I'm really honored to have a dear friend, Richard Duncan, been friends for years. He helped Kim and I time the last turn back in 2008. We made fortunes because while everybody was selling, we were buying. And that time has come again. And so that's why please listen to what Richard Duncan has to say.
A few months ago, the Fed was still creating $120 billion every month. And then in November, they said they were going to start tapering that, reducing that by $15 billion a month. But the very next month in December, they said they're going to double that and reduce it by $30 billion a month. And that meant that it's going to come to a complete stop. The money printing is going to end totally early next month.
No more printing next month.
No more printing. And then the real blow came because in early January, they started letting it be known that they were planning to do the opposite. Instead of printing a lot of money through quantitative easing, they're going to start destroying a lot of money through quantitative tightening. Now, when they print money, that pushes asset prices up. When they destroy money, that tends to make asset prices fall. And when the stock market could hurt that, they freak out.
How do they destroy money?
Well, they destroy money because when they print money, they buy bonds with that money. And normally when the bonds mature, they just roll them over and buy a similar kind of bond. but they destroy money by essentially selling those bonds. And when the Fed, what happens is the bonds mature and the Fed doesn't roll them over. Someone else has to buy the bond. So the Fed gets its money back. And when the Fed gets money back, the money just evaporates. The Fed doesn't need to keep any money because it can make all the money it wants anytime it wants to. So it's a bit complicated to explain in just a few sentences, but the bottom line is it's the opposite of quantitative easing. Quantitative tightening destroys money, and that tends to make stock prices fall. And we're about to get a heavy dose of quantitative tightening coming into effect within the next couple of months.
And it's going to make it harder and harder for mom and pop to go buy that house they're going to flip.
And isn't that going to drive inflation through the roof?
Well, they think the opposite. When they, instead of printing money, that's the thing that normally causes inflation. It stimulates the economy, it creates growth. But when they destroy the money, that tends to make asset prices fall, like stocks and property. So people are less rich, so they spend less money. And if they spend less money, then prices tend to fall. So that's why they're doing this. They're worried now that the inflation rate has moved up to 7%, and they're taking steps to bring it back down. But what they may find is this could cause a significant stock market crash. And already last month, the S&P fell almost 10% and NASDAQ fell 15% between the 4th and the 27th last month. And some of the high flying stocks got hit a whole lot harder than that.
Look at Meta or what Facebook, whatever those are called now, they tanked.
It lost 26% in a day, destroying $230 billion of American wealth.
There goes your 401k, sweethearts. And that's why I spoke out against 401ks forever, you know, and then all you guys who are going, you're planning on renting your property, people won't be able to afford the rents. That's what it means.
Well, so total credit is equal to total debt, because one person's loan is another person's debt, right? So the two have to equal each other. So one way of thinking about this, the easiest way to think about it is all the debt in the country. Government debt, household sector debt, corporate debt, financial sector debt, all the debt. It first went through $1 trillion in 1964 when I was 4 years old. Now it's $90 trillion, from 1 trillion to 90 trillion during my lifetime. And this credit explosion, which would not have been possible if we had remained on a gold system where dollars were backed by gold. But this explosion of credit has transformed the world.
Wait, Richard, hang on. You're speaking like an economist again. Credit is what the Fed and the Treasury allow people to get to the big banks like Wells Fargo and all that. And that credit then allows people, the banks, to send out debt. So then corporations and individuals come in and they take credit and they turn it into debt, but it's the same thing. So by creating credit, debt could explode. Am I correct on that or incorrect?
No, I think you put that exactly right.
Yeah, credit's not a word people use. They use credit card, but they think about debt, their household debt. So that's what I'm saying. We don't teach economists, you know, we teach everyday mom and pop who's trying to speculate on their 401k or their house.
The reason I tend to use credit is because I say this system that we have now is not capitalism, it's creditism.
Yes.
Creditism sounds better than debtism. I tried that.
That is so-
Creditism works better.
Yeah,
Capitalism to creditism.
No,
Because
but
credit
Richard-
growth drives economic growth now. We're dependent on it.
yeah, what Richard is saying is the way America grew was because we produced products. Now we don't produce products, they create credit or debt. Am I correct on that one?
That's right. Instead of our economy being driven by investment and savings as it used to be, it's now driven by credit creation and consumption, and more credit creation and consumption. And that's been great. The problem is it requires credit growth to survive. If credit contracts, we have a depression. And that has made us dependent now on government borrowing and government spending to keep us out of depression.
So if you're going to buy, I mean, I don't know how many people, I took your advice. I bought a house. I'm going to make some money. I said, at the top of the frickin' market. And what about all these guys in this 401ks? 401ks came into existence in 1974. It was called ERISA. And I've been speaking out against 401ks because I don't get censored with this one. But 401ks are like a condom. It gives you a false sense of security where you're being screwed. Do you know what I mean? And if this market crashes, when they raise these interest rates, if they do, your 401k turns to 201k, just as you get ready to retire. All you old guys like me, hear what I'm saying? If they raise interest rates because they're going to stop inflation, your 401k may be toast. I'm not saying it's going to happen. Or if you're a millennial and you got mom and dad who are living in La La Land with their 2 401ks, you might be in serious trouble.
Oh my God. All right, so I guess y'all know y'all's 401k is toast. All right.
Hold on, man. Hold on. I mean, you got to take that kind of shit with a grain of salt.
I agree.
I mean, everything has context and nuance is what I'll say. So, just.
But this is the point I think they're trying to make. The America of the olden days, like 70s and 80s, it was an America of savings, right? The way you bought a house is you had to save up 20%. Then you take that money to the bank and you get a loan. And that's a foreign concept. Well, I guess it's not foreign, but I think more and more people these days don't do the save first. More and more people these days, even when it comes to other things, buying cars, buying anything, we break that credit card out, and we spend it first and we pay for it later. And what they're saying, is that the way that we do, the way that we're doing things is backwards. In order to build wealth, you have to invest, you see your investment mature, then you have the money and you can reinvest into something different. You can't just spend, and then hope to pay down the line, or put the payment off for down the line, because down the road we don't know. Like there's uncertainty down the road. It's kind of like that 401k. It's a great tool when you're 20, but you can't have your money in a 401k when you're 10 years away from retirement. Or there has to be a plan to transition your money out of the uncertainty, because you're certainly hoping to retire at a specific date. But if you have uncertainty involving the money, the very money that you're going to use to pay for your retirement, that doesn't work. The math is jacked up. And what we have to understand as individuals is this the same thing with our household. You can't manage your household based on uncertainty of the future, right? So if anytime that there's this big upheaval, right? We're in a recession, or we're, some people say we're in a recession. Some people say we're not quite. The classical definition of a recession, we was in one last year. But with the way people spend money and all the other stuff, it's not technically a recession. But if you're in those times, that is generally not the time that you go and create debt, because that recession could very well end up in a depression. And you don't want to give out all your money and then need it, if times get worse. That's basically what he was saying in the video. And that's basically what all these videos are saying, is you have to understand what situation and what environment we're in. When you see the big boys cash out, then you should be cashed out. You should be hanging out waiting to, right? They're not investing their money. They've cashed out. They've taken their money out because they don't know how bad it's going to get. But once it hits the floor, then they'll go all in with their money. And as it recovers, their money is going to get bigger and bigger. That's how the rich become richer. That's exactly what the rich dad, poor dad was talking about. Hey, I'm not going to get debt right now. I'm waiting until the smoke clears. Then I'm going to go in and I'm going to use my cash to buy my way.
Can't hear you.
You went
John.
mute.
Okay. You guys hear me now? Can you hear me now? Can you hear me now?
Yeah, we can hear you.
Okay. So basically, what they're saying is they're not spending their money now. It's not the time. They're cashed out. Once the smoke clears, once the market crashes, once the problem is solved, then they're going to go in with their billions of dollars and they're going to drop it into those companies that are going to survive, and then they're going to ride it up. And of course, that money will triple or quadruple or whatever, right? So you have to have a plan. Now, I see people asking me what I think. Nope, I'm not a financial advisor. I can't give you financial advice, but what I can tell you is go talk to your financial advisor. I think that you should be debt free. You should work yourself out of debt. That might not be possible, but what I'm telling you is the frivolous spending, right? Buying on things that you don't absolutely need that's going to run you in debt. I'm not participating in any of that. You know, once the dust clears, then I'm open to doing all that stuff. You know, if you're in a great situation and you're cash positive, that's awesome. If you are not, you know, you probably need to work yourself to that, and you need to, you know, contact somebody, some financial advisor, but tell them, hey man, I'm not interested in spending a bunch of money. I want to try to insulate myself from some of the carnage that's going on out in the streets. So I don't know what that looks like. I don't know what kind of tools that are out there that are going to, you know, pay you at these times. Maybe some money market account. I don't know. I don't know what that looks like. But if your cash is just sitting in a bank and they're giving you 1%, that's not going to help you, but it's not going to hurt you. If you know, like you could have your cash in some investment, and that the value of it drops tremendously, and now you're hurting. So I don't know what the right answer for you is. You know, if you're cash positive, then maybe you're what do you call it, dollar cost averaging into whatever, right? Which is cool. But if you're not cash positive and you know you're living on a deficit right now, you have to figure how to get yourself out of that situation. You know, again, I don't know. I mean, but talk it over with if you got a significant other, you know, talk it over with them. But if my money is in some checking account, I want the highest interest. I want to get back for it. And maybe that means it's a money market account. Do you guys understand? This is what you should do. You should write down rising interest rate, slowing economy, and high inflation. And you should research those. Just, you know, you can YouTube all of those subjects and how they affect each other. That will give you a more clear picture of what to expect. Now, just like when you know, in these markets where we know what to buy, what to sell, and we understand the fundamentals behind the market moving the way it's moving, it's the same way. These are the fundamentals that work in your everyday life, right? It's not just the fundamentals that affect the currency moves, but those currency moves are going to affect your real life situation, right? Raising the higher the interest rates are raised, is going to put pressure on your employer. All of us work for somebody if you're out there working. So you have to understand how that pressure is going to affect your employer. And you can insulate yourself. You know, if you're trading, you know, I hope the overall goal is to be able to replace your employer. Then it won't matter in the first place. I mean, it won't matter anyway, but it gives you a better idea of what to expect, and when you start seeing things, like when you start seeing these banks crash, you look around, be like, man, what the hell is going on? You kind of understand why some of these banks are crashing, or what's actually going on. Do I have any questions? Brad. Okay. I'm going to drop that video. It's about 3 hours, 3 hour and 50-some minute video maybe. But as soon as we get off this call, I got to find it because I don't know exactly the exact title of it. But it was a great discussion. And like my brother said, you can't hang on to every word of these guys' personal opinions, whatever their political affiliation is, right? You can't hang on to every word in that regard. But the general points, as far as how they're managing the money, what they're looking at to measure, to take a temperature of the economy, those are the things that you want to grasp from these videos. Like whether you like a politician or not, that's immaterial. But you should understand what side of a trade you want to be on, right? Like what you think should happen. It's kind of like you can look at a chart and you can see a bearish or bullish move. You want to be on either side of that move. You have to make a decision on which side of that move you want to be on. It's the same with your politics, right? You can base your every decision on whether you're a Democrat or a Republican, but the society will be better off if you base it on what the right thing to do is. So if you understand what the right thing to do is, then you'll start at least having the information in your head to make an informed decision. All righty. I want to kind of transition, I guess, and go into these charts. And I almost killed the meeting. Hold on.